Yeah, so right before we start, I'll just say to everyone, this will be recorded. It will show up on YouTube. So if you don't want to ask something that you don't want the world to see, don't. I think you should feel comfortable asking Professor Demateron anything that you want to ask
There
him.
are no stupid questions in
I agree.
valuations. If you're holding back, then I think you're holding back for all the wrong reasons. So if you're still not sure what a free cash flow to the firm is, ask it, right? Because 80% of the people who use free cash flows really don't have an intuitive understanding of what exactly a free cash flow to the firm is. It's actually a very counterintuitive measure. So I'm going to talk. So if you have any questions that ranging from the very basic to kind of a conceptual, what the heck are we doing? Why are we doing it the way we are? Anything is fair game. And that's why rather than start with an Excel spreadsheet and stay with, I know that's one of the main things you want to get out of this, go line item by line item. I'm going to actually take snapshots of my Excel spreadsheet and do it as a presentation, because once you get an Excel spreadsheet, it's very easy to get distracted. You get dragged away in directions you don't want to go. But I'll click back and forth between the spreadsheet and the presentation to kind of illustrate some things that change if you change an input. Yeah.
Awesome, Professor. So I'll hit record and I'll say one sentence. I want to introduce two people as well as yourself, and then we can turn it over to you.
Sure.
Recording in progress.
All right, fools. I'm John Rotanti, and we're joined today by Professor Aswath Damodaran. He really needs no introduction. He is the world's foremost expert on corporate finance and valuation. He's a professor at NYU. He is a prolific writer and researcher, and he is also an investor himself. Professor, I just want to say we're joined today by Andy Cross is our Chief Investment Officer, and Ron Gross is our Director of Operations for our U.S. investing team.
That's
so,
great.
Professor, thank you so much, and over to you.
Okay. Before I start, if you can turn your camera on, I would love to. Of course, if you're planning a Jeffrey Tubin, don't do it. But if you can do it, I'd love to see you, because I think that's it's easier when you can see faces than when you see those gray boxes. So it's up to you. So, but if you can turn your camera on, I'd love to see faces. So I'll set out the agenda for what what I hope to do in this session. It's basically, let me make sure you got the right slides. Yep. I want to talk a little bit about valuation in general first. I want to lay the groundwork for the first 15 minutes, because I think one of the most dangerous things that people do in valuation is open an Excel spreadsheet and go to town on it without getting the basics nailed down. Because two things happen. One is valuation becomes financial modeling, right? After a while, it's not a valuation, it's an Excel spreadsheet. The other is, by its very nature, Excel spreadsheets are line items, right? With each line item, you get to pick what you want to. And it's human nature to pick whatever you like for each line item. So you want revenue growth, you want to come up with a high value, use a high growth rate. You get to margins, you want a high value, use a high margin. You forget that this is a business. For a business to have higher revenue growth, often it has to cut prices. If you cut prices, your margins decrease. So your business strategy might be go for growth, but that might come at the expense of lower margins. What I'm trying to say is everything in valuation is interconnected. If you change one thing, everything else changes with it. So that's why I don't want to go to the Excel spreadsheet, because I can tell you each input and say this is where you get it. But at the end of the process, you're going to be just as much as in the dark as you were before the process, because you're going to get each line item nailed down, but you're missing the point of what a valuation is. So enough, of this of the startup process. Let's cut to the chase. I want to first draw a contrast. This is something I have an obsession about. My students in my valuation class get tired of me saying this, because they would say something like, I value this company is. And I say, before you go on further, have you valued the company or have you priced the company? So let me draw the contrast between those two words, because they get mixed up all the time. I don't blame just practitioners. Academics have been doing it for 50 years. They act like value and price are interchangeable words. We know what drives value. We've known for hundreds of years. It's cash flows, growth, and risk. You can dance around this as much as you want, but when you look at a business and say, what's the value of the business? It's driven by cash flows, growth, and risk. That predates discounted cash flow valuation. For those of you who know the history of discounted cash flow valuation, it was born in 1938 in a book by John Williams. But people have been valuing businesses for hundreds of years. The Venetian glassmaker in the 1400s, when he sold his business, sold it to somebody who thought about the cash flows, growth, and risk. They might not have used betas or risk premiums, but guess what? They used discount rates that reflect risk. They thought about cash flows. In fact, they were probably much more honest about thinking about cash flows because they didn't have this accounting dance going on, distracting you, saying, look at the earnings, look at the earnings, look at that shiny object, when in fact it's cash in, cash out. Value is driven by cash flows, growth, and risk. So when you do a discounted cash flow valuation, doing it right, and we'll talk about some of the ways it can go off the tracks, you are trying to estimate the value of an asset, value of a business, the value of a company. And already I can tell you there are some things that cannot be valued. Because its value is about cash flows, growth, and risk, and an investment that doesn't have cash flows cannot be valued. Like what? If you ask me the value of Picasso, I'm going to laugh at you. A Picasso, you might decide, is worth a lot to you, but it's not an asset. It's not a cash flow generating asset. But let's make this, in the last 12 years, you know what the most common question I get asked in emails is? Is Bitcoin undervalued or overvalued? The question makes no sense because there are two ways you can think of Bitcoin. It's either a currency or it's a collectible, right? Even the people who advocate for Bitcoin, you got to go down one of those two paths. If it's a currency, currencies cannot be valued. They can be priced. They get priced against each other all the time. We call it an exchange rate, right? Currencies cannot be valued. They can be priced. Collectibles can't be valued either. We talked about Picassos. We talked about a baseball card. If Bitcoin and gold is the oldest and the most enduring collectible of all, there is no value for gold, but there's a price for gold. I'm not saying the price is irrational. It's set by demand and supply. The price of an investment is set by demand and supply. Now, if you lived in a world where markets were efficient, the two numbers might converge. You see why? Because the demand and supply is driven by cash flows, growth, and risk. It's driven by fundamentals. And if the two converge, you've got an efficient market. The start of every one of my valuation classes, people ask me, do you believe markets are efficient? Which my response is, if I believed markets were efficient, why the heck would I be teaching this class? You know how long a valuation class would last in an efficient market? You ask me, what's the value of Peloton? Just open the newspaper and look it up. Or go online and check the stock price. Because in an efficient market, the best estimate of the value is the price. Now, this might be pure delusion on the part of all of us, but let's face it. We are starting with the presumption that the pricing process, and by we, I include people at Motley Fool and others saying, I can find cheap stocks and expensive stocks. Whether this is true or not, you're starting with the presumption that the value process and the pricing process can yield different numbers. Most of the time when people talk about valuing things, equity research analysts should stop talking about value. They're pricers, right? What's your job as an equity research analyst? To put a buy or a sell recommendation. Your job description is a pricing description. I give you 15 chemical stocks and I say, which one is the cheapest? You compare it to the other 14. You're doing your job. Just stick to your job then. Because the way you do that is you standardize the price, right? How do you standardize the price? You divide by something. A multiple is just a standardized price. You see this in every business. When you buy real estate, it's price per square foot. Pricing is about being standardized. And when you use a multiple, please, please, please stop using the word value for what you've done. So if you've got 15 comps and you've got a PE ratio, EV to EBITDA, that's absolutely okay. But you're pricing the company based on other companies. That's the essence of pricing. A few years ago, I wrote a piece on VCs because VCs love to talk about the word value too. Again, an entire group of people have no business talking about the word value because the VC business is all about pricing, right? How do you get to be a great VC? You get in at the right price, you get out at the right price. Mark Cuban is a great VC, at least in the terms of, in terms of reputation, not because he built a great business. The business he built, broadcast.com, ceased to exist in 2001. He's considered a great VC because he got in at the right time and more importantly, got out at the right time. He sold his business for $5 billion and he walked out. So when you look at VCs and how do they attach a number to a company? They price it. They price it per user, per subscriber, per download. You divide the price by some positive number. If you run out of numbers, you just make up numbers. Number of cars in the parking lot. Desperation drives you to do strange things. So the minute you say, I want to value a company, be honest with yourself about whether that's what you want to do. Because investing is mostly a pricing game. How do portfolio managers get judged? Relative to other portfolio managers. It is a pricing game. You don't have to make money, you just have to lose less money than everybody else and you're a star. If you're doing valuation, you're already the outlier in this game. And if you're a portfolio manager and you're an outlier, you get fired. That's why portfolio managers, even they start as true believers in value, end up as believers in pricing because your time horizon is only as long term as your shortest term client. So if you're a Fidelity mutual fund manager, I don't care what your time horizon is. It's what's your time horizon of your clients. If they're pulling money out after 3 months, guess what? After a while, you're going to be running your portfolio saying, how can I make the most money over the next 3 months? Now, I could do a session entirely on pricing. And it's actually a good session to have because pricing has nothing to do with finance. It's got to do with data and statistics, right? In other words, right now, the way we price things is incredibly unsophisticated. We throw data out. I've seen equity research analysts say stock is cheap. Why? Because its PE ratio is 12. The average PE for the sector is 15. Come on, guys. This is in 1967. You've got the entire sector in front of you. You've got 50 companies. You've got the PE ratios of all 15. Why are you using just the average? Why not look at the distribution? But the problem is our statistics classes discourage us so much while we're taking them that we throw them out right after we're done. And pricing, that's the skill set we want. But today's session, I want to talk about value. And I'll tell you why I believe in value. I believe in value because I have one client. Actually, I have 4, but the 4 of them, the other 3 don't even look at their portfolios. So I'm really the only one who looks. My client is me and my family. It's an advantage that I have over a portfolio manager. I mean, people often complain about the fact that the portfolio manager has more money. Think of the biggest advantage you have over a portfolio manager. You control your time horizon. That is a huge advantage to have. I believe in value because I have faith. Strange word to use, right? Because let's say you buy something undervalued. The price is much lower than the value. You go out and buy it at the price. For you to make money, what has to happen? The price has to converge in value. Guess what? We're all believers in efficient markets. The only question is when markets become efficient. Incredibly convenient for us. We buy in an inefficient market and then we sit down and say, please God, make this market efficient because I need to make money. There's a little bit of hypocrisy in active investing. You see that? This is why people beat up on efficient markets. I sit back and smile. I said, really, guys? Do you want markets to be truly random? If markets were random, how the heck would you ever make money? So I believe in value because I have faith. Faith that the price will converge on value. And you know I use the word faith, right? There is no guarantee it ever will. And that's something you have to accept up front because if you don't, you're going to get incredibly frustrated. I've been invited to Omaha at the end of the next month, and I've said I'm not coming. First, I have the week before the finals week. I don't want to go there. Second, it's full of bitter old people now. Old-time value investors have become incredibly bitter and pissed off and frustrated and angry. You know why? Because the world has turned against them. You say, what's wrong with markets? And then they bitch and they moan and they wag their fingers saying, this is like going to a conference of fundamentalist preachers. And they're talking about, you're going to hell. You bought those tech stocks. You deserve to go to hell. Now I'm going to get down on my knees and pray that they all go to zero so you can go to hell. Notice how secretly joyous, they're sometimes not even that secretive, how joyous they become when tech stocks correct. I told you so. I've been telling you so for 20 years. Hell is coming. But I think that I have to use the word fate because I have to accept the fact that even if I do everything right and I get value right, and there's no guarantee I will, I could end up not making money. And I'm completely okay with that. I didn't start off with that point. But I would encourage all of you to get to that point. In Buddhism, this is the definition of the word serene, right? You've reached a point where you say, I've done everything I can. I didn't do it because I expected to get rewarded. If I do, great. If I don't, I'm okay too. I'd rather be rewarded than not rewarded. But I have faith that price will adjust to value. And if it doesn't, it is what it is. So with that lead in, let's talk about what drives value. You look at a company. Now, we think about discounted cash flow models, but remember, the essence of value is you're trying to answer 4 basic questions. So I'll go through the questions. This covers any company of value. The first question is, what are the cash flows you're generating from your existing investments? So some companies, this can be an immense number, right? Apple, Microsoft. What are the cash flows you're generating from existing assets? So you pour over the financial statements, you look at the earnings, the cash flows, and for a company like Coca-Cola, Kraft Heinz, or Microsoft, or Apple, there's a lot there. But if you do this for a Palantir or an Airbnb, there's not much there, right? It's not because they're bad companies, but because they're young companies. When you spend all of your time looking at the financial statements for a Peloton, and you're trying to value Peloton, you're looking in the wrong place. A financial statement is a recording of history, and by definition, there's not much there. You're saying, so where does the value come from? It comes from answering the second question. The second question is, what is the value that you're going to add or destroy by growing? We've been trained to believe that growth is somehow this glorious thing. That growing is better than not growing, right? It's kind of embedded in investing, and it's completely false. Growth can add value, growth can do nothing for value, growth can destroy value. One of the most depressing things I do at the start of every year is after I've computed all these numbers for 46,000 publicly traded companies, I do a computation of what the cost of capital is for each company, which is relatively simple. One of the things I'm going to talk about is how much time we waste finessing discount rates when we should be spending talking about cash flows. I get the cost of capital, and the median cost of capital for a global company now is about 6.3% in dollar terms. File that away. It's never been this low in history. We have the lowest hurdle rates in history. This is good, right? But here's the depressing number. 57% of global companies earned returns on their invested capital. And it's an accounting number. I don't trust accountants, but to the extent that you do, that's less than the cost of capital. 57%. That's 28,000 companies earn less than their cost of capital. You're saying, so what? You know what happens when you grow and you earn less than your cost of capital? You're destroying value. Every time you grow, my value goes down. It's almost a perverse exercise. It's like having one of those heated, or make it an air conditioner. You make it cooler, but the hot air, it blows out more hot air. That's exactly what's happening here. You're growing faster because you've been told that's the answer to your problems, and your value goes down. So when I ask you what's the value of growth, you need to bring in two things. One is the good side of growth, which is it pushes up revenues, pushes up earnings. But then you've got to ask, how much do I have to invest to get that growth? Growth is never free. Do you have to build an extra plant? Do you have to invest more in R&D? If you're a customer, a subscriber-based company, how much money do you have to spend on customer acquisitions? We're not asking the right questions of these user-based companies. For Netflix, what's been its calling card for the last 12 years? It goes to market and says, look how many more subscribers added. How often do you see equity research analysts ask two questions? How much did it cost you to add that extra subscriber? And second, how much value is that extra subscriber bringing in? Netflix hit a mature market in the US. So if you look at the US, pretty much everybody who wants to watch Netflix has it. Right? Because you're saying, but they don't have 200 million. You don't need 200 million subscriptions. Remember, there are 5 people on my Netflix account. And I'll wager there's almost nobody in the country with a single person Netflix account. And I'd like to see that sucker wherever he is and say, what's wrong with you? They've hit a ceiling in the US. Guess where their growth is coming from? When you see the numbers added. It's coming primarily from India. The good thing about, when you think about a company going to India and China, you know what the biggest sales pitch is? 1 billion people. That automatically, especially if you use a subscriber-based company. It's coming from India. And here's the problem with an Indian subscriber. You know what Netflix costs in India? There's a $3 version every month. You can watch only on your smartphone, but 80% of Indians, that's the only device they have to watch on. It's not like they have a phone, an iPad, and a 50-inch TV hanging in their hut. I was waiting for somebody. So about 2 years ago, they reported they had 6 million extra subscribers. 4.5 million came from India. I was waiting for somebody in that audience to say, well, what's your value added from a subscriber? Because that would have been revealing, right? The value of a US subscriber is about $500. And I'm including value over the lifetime of a subscriber. I did this about 4 years ago, I valued a subscriber. The value of an Indian subscriber is about $100. 6 million Indian subscribers is worth a lot less than 6 million US subscribers. But equity research analysts just looked at the number of subscribers. So when you talk about the value of growth, you're always the skunk at the party, right? Because these growth companies love to talk about the good stuff, but nobody wants to talk about what you need to deliver to get that growth. The third question I need to answer to is, how risky are you? Notice I didn't ask you what's your beta. Don't mistake models for first principles. You don't like the CAPM? Throw it out. But don't tell me because you don't like betas that you don't correct for risk. That is absurd. You need to clean up. You need to correct for risk somewhere. If you don't like the beta and CAPM and all the theories that come from finance, and I agree they're all flawed, come up with your measure of risk and build it into your discount rate. And then put closure. Why closure? Because you can't have a spreadsheet that keeps going and going for 16,000 columns. So at some point you stop and say, I'm tired. I want to stop, and I'll let you stop, but then you can't give up on what happens after that point in time. And in every discounted cash flow valuation, this is the elephant in the room, right? Because when you stop, I say, what's your company going to be worth 10 years from now or 5 years from now? And this is where the real damage to valuations gets done. Because you get your hands on perhaps the most disastrous equation in all of valuation. It's not a valuation equation. It's actually a mathematical equation for an infinite series. If you have no idea what I'm talking about, you get to a point in time and your growth and your discount rate are going to be constant forever. You have an infinite series. 200 years ago, mathematicians solved for the value of the series. We stole it in finance. We act like we invented it, but that's a terminal value. When will you be a mature company, a company that grows at a constant rate forever? So when I look at a DCF, I'm looking at the answers to those questions. And if you're going to frame a DCF, there are two ways you can think about DCFs. The most common way is to take expected cash flows. Keyword is expected, right? Because there's uncertainty. So when you talk about scenarios and different things happening, everything should be incorporated in the expected cash flow. There's no garnishing allowed here. Where after you've done the expected, say, oh, by the way, there's a bad scenario. If there was a bad scenario, why isn't it in the expected cash flows? And you adjust for risk in your discount rate. In a conventional discounted cash flow valuation, the discount rate carries the entire burden of risk. There's an alternate way to do discounted cash flow valuation, which you almost never see, and you're going to see very quickly why not. You could take your expected cash flows and replace them with what are called certainty equivalents. Sounds fancy, right? Have you ever seen the Howie Mandel show, Let's Make a Deal? It's a really stupid show, right? In the show, here's what happens. You're a contestant, they call you up. There are two suitcases up on the podium. One is $1 million, the other is nothing. And the way the show works, and this is the entire show, Howie Mandel offers the contestant. So the contestant knows one suitcase is $1 million, one is zero, and one of the suitcases is going to be opened. So if you were completely risk neutral, how much should Howie Mandel have to offer you to walk away? Because he offers you a fixed amount to walk away. If you're risk neutral, you're going to say, the expected value is $500,000, give me $500,000. But that's what the show is about. He starts at $250,000, then he tries $300,000. Because if you're risk averse, guess what you're going to do? Would you rather have a certain value of $400,000 and take the bet? People say, I'll take, and the more risk averse, that's what a certainty equivalent is. Imagine applying this to valuation. I come to you with Coca-Cola and say, the expected cash flow in Coca-Cola next year is $3.36 per share. What would you accept? So you'd need Howie Mandel sitting behind you in the desk saying, what cash flow would you take for year one? No wonder people don't use it, but some people actually do this in kind of not the full calculation, but they take shortcuts. Now, I say good things about Warren Buffett, and I do say some mean things about Warren Buffett, but I think he says things that sometimes people take literally because he actually says them. There's a long time ago he did say once that he didn't like betas. In fact, he discounted his cash flows. He doesn't use the word cash flows, he uses owner's earnings at essentially the risk-free rate. He no longer says it because the risk-free rate has gone to close to 1.5. This was on risk-free rates of 6%. So he was, I think, making a point that he didn't like betas. But that's a crazy thing to say, right? You're using the risk-free rate. And I remember every class I get, somebody listens to something Buffett has said. But Buffett doesn't adjust for risk. Why should I adjust for risk? And I said, have you taken a look at what measure of earnings Buffett uses when he values companies? And one of the things Buffett has always said, he looks at the earnings he can count on. He says some very fuzzy things. I don't know what that means, but effectively you step back and say, look, I'm going to count earnings that I think the company can deliver on a regular basis. I'm not counting the speculative earnings, and I'm not using the word speculative in a bad way. The earnings that so you know what he's doing, right? In a kind of a qualitative way, he's replacing earnings with certainty equivalents. One of the things I would caution is when you value companies, don't try to be conservative. It's a dangerous thing to do. You know what I mean by being conservative, right? So I'm going to use a lower growth rate than I expect. I'm going to use lower cash flows than I expect. And then you proceed to discount those cash flows at a risk-adjusted discount rate. You're double counting risk. I'm not arguing you shouldn't consider risk. Keep it in one place in evaluation, because if you let it seep into multiple places, you've lost control of it. So most discounted cash flow valuations, you're basically looking at expected cash flows and discounting back at a risk-adjusted rate. Now, before we actually look at the spreadsheet, you got to make a choice. When I ask you to value a company, you can either value the entire company or the equity in the company. And people wonder, what the heck are you talking about? Company equity? I'll give them the analogy of buying a house. How many of you own houses or apartments? So think about the process, right? You found a house you liked, and unless you're a drug dealer, what did you have to do when you bought the house? You borrowed money, right? So let's say you bought $1 million house. If I'm insulting you by making your house less valuable, add an extra zero if you want. And you borrowed, let's say, $800,000, which is not uncommon, right? You put 20% down, that's pretty high by today's standards, to buy the house. Right after you buy the house, if I ask you what's the value of your house, at least you paid $1 million. You say, well, right now I hope it's $1 million. If I then ask you what's the value of the equity in this house, it's 200,000, right? With houses, we know it's clear what. So when you talk about businesses, the question I'm asking is, do you want to value the business or value the equity stake in the business? For a company like Apple or Google, the numbers are going to be very close. You know why, right? They have relatively little debt. Apple has 100 billion. That sounds like a lot. When you're a $3 trillion company, it's a fraction of your value. But we value a Con Ed. There's a big difference between valuing a business and valuing equity. You got to make that choice right up front. Because the way you think about everything you do in valuation is driven by that choice. If you decide to value the equity, then you got to focus on cash flows you receive as an equity investor. And you discount those cash flows back at the rate of return you need to make as an equity investor. A lot of fuzzy words there. Let's focus on cash flows to equity investors. If I'm very strict in my definition of cash flow and say I'm only going to count the cash flows I see, what's the only cash flow you get as an equity investor in a publicly traded company? What's the only cash flow that's tangible that you can see?
Dividends.
Dividends. The dividend discount model is the oldest discounted cash. It's an equity valuation model. And when you use dividends though, what are you doing? You're trusting that companies pay out what they can afford to pay out. You're assuming that companies are run by sensible people. Very bad assumption. Because the reality is we know beyond any semblance of a doubt that companies don't pay out what they can afford to in dividends. How do we know that? What gives them away? There's one item on the balance sheet. Look and say, you guys are lying. The CFO gets upset. We paid every dollar. If Apple, let's say Google, and say, no, you know what? We couldn't afford to pay dividends. That's why we didn't pay dividends, because they haven't paid dividends. What's the number on the balance sheet that tells you that they're lying?
Retained earnings.
Wrong side of the balance sheet. Go to the other side. When you have cash flows you cannot afford to pay out, you know how it shows up? As a cash balance that gets bigger and bigger and bigger over time. Companies don't get big cash balances because they get manna from heaven. They get big cash balances because they deliberately withhold cash. I'm not saying it's a good thing or a bad thing, but the problem with dividend discount models is while they're straightforward and simple, they will consistently undervalue companies that hold back on cash. If you apply a dividend discount model to Google, don't be surprised if it's worth close to nothing. And don't tell me the model's wrong. It's not the model's fault, it's your fault. You focused on actual dividends when you should have looked at potential dividends. So how the heck am I going to compute? It's the easiest number to compute, potential dividends, right? It's cash left over after you've met every conceivable need. You know where you can get it? Go to the statement of cash flows. Start with the operating cash flows, subtract out the investing cash flows, and then subtract out debt payments, and guess what you're going to get? You're going to get cash flows the company could have paid out. I'm surprised that companies even tried to say they can pay, because the proof is right there. I can compute what you could have paid out last year. Conversely, if you have companies that pay out more than they can afford to in dividends, a dividend discount model is going to make every one of these companies look cheap. Be very careful with dividend discount models with banks in today's environment. Because banks pay dividends whether they can afford to or not. They've been almost trained that this is what you're supposed to do. If you have an undercapitalized bank that's got an 8% dividend yield, you're saying this is amazing, an 8% dividend yield. You buy that stock, it's not a question of whether this is going to blow up, it's when it's going to blow up. So when you adopt the equity approach, you look at cash flows to equity, either dividends or potential dividends, discount them back at the cost of equity. If I ask you to value the firm though, you got to do something counterintuitive. You got to think of lenders as partners in this process. You see how they're partners? If you think about a business, it's raising capital, right? Some from equity, some from lenders. They're both providing capital. Lenders get cash flows back in contractual payments, interest payments and principal payments. Equity gets a residual cash flow, dividends or potential dividends. What if I thought of them as partners and look at the collective cash flow? I told you it's extremely counterintuitive, right? But what business owner thinks of the banker as his partner or her partner? I'm saying think of the banker as your partner. The collective cash flow that equity investors and lenders get from a business is the free cash flow to the firm. So when you think about free cash flow to the firm, don't think equations. Think about this as the collective cash flow that capital providers to the firm get from the firm. And if that's the cash flow you're discounting, the cash flow is to be discounted at a rate of return that reflects what both equity investors want, which is, let's call it the cost of equity, and what lenders demand on their borrowing, which is the cost of debt, which of course in corporate finance, that weighted average is the cost of capital. You'll be amazed at how many DCFs I see where right at the top you can stop and say this is not going to work because you're taking cash flows to equity and discounting at the cost of capital. That's an absolute no-no. Cash flow to the firm discounting at the cost of equity. Or comparing return on equity to cost of capital. What are you thinking? If you compute return on equity compared to cost of equity, return on capital compared to cost of capital, it's a first rule in both corporate finance and valuation is once you adopt a perspective, the way you measure things is going to be driven by that perspective. Now, very quickly though, when you think about why valuations go off the tracks, it's not because the mechanics go wrong. The mechanics are straightforward. I can teach people the mechanics of valuation in an hour and a half. The reasons valuations go off the track have nothing to do with the mechanics. It's the three biggest enemies of valuation. The first is bias. Let's face it. There is no company you ever value with a blank slate. John wanted me to value Domino's. I looked at it and said, so boring, I didn't want to do it. But when you look at a company, you never look at it with completely unbiased view, right? You pick the company for a reason. You either like the company, you hate the company, you like the management, you hate the management. You see where I'm going, right? Your priors and preconceptions will find their way into your valuation. Don't fight it. You're a human being. Those are part of what valuation is about. All you can do is be honest with yourself. Don't give me this crap about you're an objective analyst. I've been fighting the CFA on this for a long time. Because they have all this thing about we train financial analysts to be objective. And stop lying. Because these financial analysts go to work for appraisal firms and guess what? Somebody pays you to do an appraisal, and the minute somebody pays you to do an appraisal, there is no way, absolutely none, that you can be unbiased. He who pays the piper gets to call the tune. Now you might get a note in there that you say, look, I made an independent contribution. Bias. Be honest with yourself. The second is uncertainty. And I want to talk a little bit about uncertainty scares us human beings. We want it to go away. So you know what human beings do with things they want to go away? They're going to deny it. I don't see any uncertainty. They shut down. You give somebody who's even an experienced DC, somebody who does valuations all the time, a young company to value. They say, I can't do that. Too much uncertainty. I am amazed at how much resistance there is among people who claim to believe in value to valuing young companies. Because there's too much uncertainty. I mean, they're forgetting basic statistics. Uncertainty means your estimates can be wrong, but it doesn't mean you cannot make estimates. We need healthier ways. I'm going to talk about a couple of things you can do to deal with uncertainty that are healthier than shutting down, going into denial, or worst of all, outsourcing. You know what outsourcing is, right? When you get really uncertain, you decide to ask an expert. You decide to listen to management. Come on, guys. It's your valuation. If you turn it over, you think McKinsey doesn't, they're going to give you some buzzword to cover the uncertainty, but they're not going to make uncertainty go away. Bias, uncertainty, and complexity. I'll give away my age. I did my first valuation in 1981. I did it on a ledger sheet with a calculator and an actual physical annual report. But when you value a company in a ledger sheet, you know how many line items there are going to be in your valuation? As few as you can get away with, because every single cell has to be hand calculated. There's no what if analysis, scenario analysis. Are you crazy? Every single number, and you learn very quickly to do everything in pencil. You know why? Because you are going to screw up and you're going to have to go erase things, and if you do it in pen, you're completely screwed. Today, think of how easy it is to get data. I can go to S&P Capital IQ or FactSet and download 20 years of data like that. Not just for my company, but for every company in the sector. I can create Excel spreadsheets that seem to build on themselves. I could build a macro that writes macros, and the next thing you know, you have 500 line items in your Excel spreadsheet. It's a recipe for losing control of your valuation. Last summer, my youngest son graduated. He was a junior at Yale, and he went to work for a hedge fund for the summer. And his job was to do valuation. And he never calls me for advice. So middle of last summer, he called me. He says, "Dad, I need your advice." And I knew already that this had to be something very transactional. I said, "Okay, what do you need advice on?" He said, "I've been told to do a 3-statement forecast valuation." You know what a 3-statement forecast value. It's one of the most absurd exercises that bankers go through, where they forecast income statements for the next 20 years, balance sheets for the next 20 years, statements of cash flows, every single line item. And he said, "I'm not sure how to do it. How should I do it?" And I said, I would tell you if I knew. And he said, "But you've been teaching valuation." I said, in roughly 40 years of valuing companies, I've never once in my life forecast all 3 financial statements. He said, "Don't you need the numbers from there?" I said, "I need 6 line items out of the 500. Why am I estimating 494 other line items that I don't need?" The lesson I would like to bring in is less is more. Fewer line items. Because people seem to think adding details somehow makes the valuations more precise. Let that go. In my 40 years of valuation, I've never once broken working capital down into its component parts. You know what I'm talking about? Receivables, payables. What a complete waste of time. If you're capable of forecasting receivables for a company for the next 30 years, I am in awe that you can do that. But what's the point if you really are just taking 26 days of receivables and forecasting that every year for the next 30 years? Bias, uncertainty, and complexity. I call this the Bermuda Triangle of valuation because it's where valuation first principles go to die. And finally, on the uncertainty front. If you think about uncertainty in a company, it evolves as a company ages. With a very young company, not only are you going to face a ton of uncertainty, because everything is in the future, but a lot of the uncertainty is going to be micro uncertainty, right? Uncertainty about the company, the management, its product, its business model. As companies age, the amount of uncertainty gets less. When you value Coca-Cola, who cares who runs Coca-Cola? Let's be quite honest. This company could be run with a robot at this point, probably do less damage to the company than whatever the company tries with its management team. Its business model is established. We know how it makes money. The uncertainty is less, and more of the uncertainty is macro uncertainty, right? It's Coca-Cola, how much revenues does Coca-Cola make from Russia? That's a big deal. What will happen to interest rates? That affects Coca-Cola. What's inflation going to do? The amount of uncertainty and the type of uncertainty you face changes over the life cycle. And the reason I'm emphasizing this is go back to Omaha. What's the one thing that you don't want to talk about? Uncertainty. It's kind of a bad word there, right? Because starting with the very beginnings of value investing, and can you go back to Ben Graham and the Intelligent Investor? Let's face it. I've struggled through Ben's books. And I know you're not supposed to say that. You're supposed to say, I read it every night like the Bible. I've tried. It's an incredibly, incredibly dull book to read.
I can't finish it.
I'm sorry?
I can't finish the book.
It's let's face it, Ben was a fixed income guy who wandered into stocks. So everything he does about is making stocks look like glorified bonds, right? Basically, how do I find a stock that gives me 6% in cash yield every year and a little bit of price appreciation? So to them, uncertainty is a bad word. So guess what's happened to value investing over the last 30 years? It's gotten squeezed into a smaller and smaller part of the market because there are fewer and fewer companies that you can think of. Even the companies that you thought were mature companies get disrupted. Value investing is getting squeezed out of the market. And as I said, it's making them incredibly bitter. But guys, you got to wake up and recognize that you have to live in the world you're in, not the world you wished you were in. So this notion of, I want to invest in something because I don't understand it. I know that come on. If you do that, as you get older, there'll be more and more of the world you don't understand. So you sit there wagging your finger at your kids saying, you're watching TikTok. That's a terrible waste of time. You need to be reading Charles Dickens. They're not going to read Charles Dickens. And TikTok is going to be a multi-billion-dollar company. You've got to be able to say, look, I'm okay with uncertainty. Because if you're not, you're going to get stuck in the portion of the market where you really don't want to get stuck. So let's keep it simple. Give me any non-financial service company. Banks are kind of a creature of their own that needs an entire session on its own with the regulatory capital and all that crap. But you give me any non-financial service company, no matter what kind of business model is, I can boil the business model down into 3 drivers. And think about your favorite company. Think about Domino's if you want, John, or any of your favorite companies. And as I talk about the 3 drivers, think about how they'll play out for your company. The first is revenue growth. That's a growth part of your business model. By itself, if I ask you, would you like low growth or high growth in your business model? You say, I like high growth. So revenue growth. And why do I use revenues? Because revenues are the most honest metric to look at growth. And you can be a mature company with high growth in earnings because you cut costs in a year or you did something. But revenue growth actually requires that you either sell more or charge higher prices. So I'm going to focus on revenue growth. That's the growth part of the business model. The second part of the business model is, how profitable is this business model? I hate to say it because it should never be said, but I might as well say it, that growth by itself doesn't deliver value. You got to figure out a way to make money someday, right? It doesn't have to be next year. It doesn't have to be, but at least tell me you've thought about the possibility of making money. The profitability of your business model I capture with an operating margin, not a net margin because that can be driven by debt and other issues. So revenue growth, operating margin. Then I close the loop by saying, hey, you liked a lot of growth, right? So tell me, can you deliver that growth efficiently? And the way I measure the efficiency with which you deliver growth is by computing a ratio that throws some people out. I say, what the heck is that? Called a sales to capital ratio. You know how we compute return on invested capital, where we take operating income and divide by. Think of sales to invested capital as replacing operating income with revenue. So you're saying, what does that measure? If I tell you my sales to invested capital is 3, I'm saying for every dollar of capital I invest, I generate $3 in revenues. So the more efficient I am, the more revenues I can deliver per dollar of capital. Now remember, some of these things are out of your control. You enter a manufacturing business, the kinds of margins you can get are very different than if you enter a software business. You enter a manufacturing business, the sales to capital ratio you can get is very different than if you're a ride-sharing company. So in each dimension, I can tell you what would you like to have, but once you tell me what kind of business you're in, I'm going to put constraints on you, right? Because you can't pick any number you want. So if you tell me you're a manufacturing company and your margin is going to be 70%, I'm going to stop you and say, that can't happen. Now, what exactly are you making that costs you almost nothing to make? The reason software companies have 40% margins is the extra unit they sell costs them absolutely nothing. So when you go to Microsoft and you become an Office 365 subscriber, it's not like there's a little person in Microsoft runs and let me produce another copy of Microsoft Office. It costs them absolutely nothing. So growth, margins, and the sales to capital ratio. And as I said, you pick whatever business, mature, high growth. I can use those 3 dimensions to capture what kind of business you are. And then, of course, I've got to bring in risk. And I'm going to bring it in 2 places. One is through the discount rate, the traditional way we bring in risk into discounted cash flow valuation, through the cost of equity and the cost of debt. But there's something I want to mention about DCF that never gets said because people are too embarrassed to say it, or they don't even realize they're assuming it. Every discounted cash flow valuation is built on the presumption that your company is a going concern. You know what that means? There'll be bad years, but you always come back because you got to get to nirvana. What is nirvana in a DCF? You got to get to that terminal value number, because if you don't get there, the valuation implodes. And we make it so casually. I'm planning to value Burbank next week. You know why? I will give my students, my advice to them is go where it's darkest. Because people are panicking. Nobody's valuing a Russian bank or a Russian steel company. I'm not planning to buy it because you can't even buy it right now. They've shut the trading down. But I want to try to value it. And you know what I have to factor in? There's a very real chance that Burbank and Severstal and Lukoil will not make it. That Putin might decide to nationalize them and my equity is going to be worth nothing. I'd be blind to that if I just took a discounted cash flow valuation. I'm going to use a high discount rate that's going to capture it. It's not going to be enough. So I'm going to factor in a chance that my company doesn't make it. It's something you don't see in DCFs. But it's something I've had to deal with because I value so many young companies. When you value a startup, you know what percentage of startups fail before year 2? 65% of startups don't make it to year 2. If I do a DCF of a startup and I don't factor in this failure risk, I'm going to overvalue the startup even if I get every single number right. So that's the structure here, and connecting all of these inputs is a story. Now, I don't know whether any of you have read my book, Narrative and Numbers. Even if you don't, on my blog, every valuation I present, I start by saying, this is my story for the company. And this is not the kind of storytelling you're seeing in Silicon Valley. Silicon Valley now, you can attend storytelling classes. They're teaching founders how to tell stories. But these are like Theranos type stories. How do you create a fairy tale that everybody can buy into? My stories are business stories. My end game is I try to connect the stories to the inputs I have, revenue growth margin. So whatever story I'm telling, I'm looking to see how does it play out. So if you get a chance, and you can look at either my blog post, I talk about the sequence I go through. I tell a story, I check to make sure it's not a fairy tale, I connect the story to inputs. The valuation kind of does itself. And then I keep the feedback loop open. You know what that means? The problem with most of us is we hang out with people who think just like us. Let's face it, there's a selection bias in this group, right? You chose to follow, join Motley Fool because you had a way of thinking about markets. And the more you hang out with each other, the more you kind of reinforce your priors. When you value a company, leave the room. Show your valuation to people who think least like you. The first person I showed my Airbnb valuation was a friend of mine who rents out Airbnbs. She has nothing to do with finance. Wouldn't obey it if it jumped out and bit her in the butt. But I wanted to see if there was something in the business that I was describing in the story that I was missing. I wanted to see what a relationship with, does Airbnb actually collect the 14%? What else does it get from her? That's a feedback loop, because you want to listen to people who disagree with you and find ways to adjust your valuation. So with that long lead-in, I'm ready to go to the spreadsheet. So you open up my spreadsheet. This is the FCFE simple ginzu. You know why there's a ginzu in the name of the spreadsheet? Most of you are too young to remember. When I first landed in the US in 1979, there were these infomercials you'd watch late at night when there had no shows. Remember, these were the days before reality filled in all the gaps. They'd sell 30-minute periods. You want an infomercial, you can buy 30 minutes. And one of the first, I think it might have been the first show, because I came from a part of the world where there was no TV yet when I left. 1979, the parts of India I left had no TV. I landed, this first thing I watched was the roller derby. God help me in terms of the first introduction. If you've never seen roller derby, you don't want to see it. It's a bunch of women knocking each other off rings, crazy violent. I mean, they're psychopaths probably. And then I saw this infomercial for ginzu knives. So this chef comes up and he says for these, he does the two ginzu knives, and then he says for these two ginzu knives, 1995. Oh, by the way, if you order it in the next 15 minutes, I'll throw these three. And by the time he was done, you had enough knives to slaughter an entire apartment house, like 50 knives. That's why I call these models ginzu models. I started with a simple model. I said, hey, it'll be nice if I can capitalize R&D in this model. It'll be nice if I can deal with leases in this model. It'll be nice if I enter a cost of capital. So by the time I was done, I had 15 knives. So you have enough in this to value just about any company. So I'll start with the easy numbers first. Okay? In November of 2021, I valued Tesla. I don't even know why I value Tesla anymore, because Tesla is a company where there's no middle ground, right? People either love the company or they hate the company. And I try for the middle ground, and I get hit from both sides, and I keep trying because I want to get this, at least the sense of it. So this is probably my 9th valuation of Tesla, November of 2021. So the first set of numbers are numbers from financial statements. I ask you, what are the revenues? What's your operating income? What's the interest expense? So those three numbers come right out of the financials. I ask you for the most recent numbers in the last 10K, and I'll explain what I'm doing here. Your valuations always have to be as of today. You know why? Because I've never understood people who value the company as of January 1st, 2022. What the heck am I supposed to do? Put myself in a time machine and go back and buy it at that? I can't do that. I've got to buy on March 9th or March 10th or not buy at all, right? So I want the most updated numbers. And for market numbers, that means today's T-bond rate, today's equity risk premium. But with accounting numbers, we face a little bit of a challenge, right? Accountants don't update every day. You can bitch and moan about that as much as you want, but it is reality. And in November 2021, the most recent financial statements from Tesla were the third quarter statements through September 30th. So what you see in the first column are the trailing 12-month numbers from September 2020 through September 2021. In the next column, I ask you for the last 10K, which is through December 31st of 2020. So basically, you have two columns, and if you just show the computer two columns, it's going to say this is what the growth rate was. But I want to caution the computer that the difference is only 0.75 years. You see why I do that? Because if you take the trailing 12-month numbers and divide by the last 10K and you tell me the growth rate is 9%, it's really 9% over 9 months, right? Because it's between December and September. So the 0.75 just creates an annualized version, tells me what the growth rate was last year. So that's really, so if you are doing this after the first quarter, March 31st of 2022, you're going to get the first quarter numbers. You do a trailing 12-month through March, and you're doing December of 2021. That'll become 0.25 because you're really looking at 1 quarter's change. So that's really to get a sense of what was the annualized growth rate of that period. Interest expense, whatever it is from the income statement, and that could be zero if your company has no debt. Book value of equity is that shareholders' equity number that's on every balance sheet. And remember, 10% of companies have negative book values of equity. You know how you end up with a negative book value of equity? You lose money and you keep losing money. At some point in time, you hit zero and you keep going. Many young growth companies with huge market caps. It's one reason book value is one of the most absurd metrics to base investing on. I've never understood this fixation with book value. There seems to be this delusion floating around that book value and liquidation value are somehow, you must have a lot more faith in accountants than I do. So even with fair value accounting, book values become this fuzzy number, but it is what it is. It's getting me a measure of what the accountants think this company is worth. So again, most recent. So that shareholders' equity includes retained earnings. So it's that bottom line number. Don't just take the, I've never understood this par value, and there's some stuff left over from a century ago in accounting statements. It's that full shareholders' equity. Book value of debt is all interest-bearing debt on the balance sheet. So under current liabilities, you're going to see short-term debt, short-term portion of long-term debt, long-term debt. And until 2019, I had to clean up for the fact that accountants didn't seem to have this blind spot with this huge off-balance sheet debt item called leases, right? I've never understood why it took them so long to get to their senses. But until 2019, I used to clean up for them. So when he said, do you have operating lease commitments? I used to say yes, and there's a spreadsheet. It's a ginzu. So basically the spreadsheet is built in. You put in the commitments. I converted the leases to debt. With IFRS and GAAP now coming to their senses, you could skip this step and include the lease debt directly in the book value of debt. Just make sure you don't double count. Don't enter the lease debt as part of total debt and do a yes, because then I'll do it as well. You know what I do? I don't trust accountants, I told you. So I take the lease debt on the balance sheet and then I do my own lease debt calculation to see if we're close. If we're close, then I go with the accounting debt. If not, but I'll tell you why you might still need this. Do you have operating lease? Even if you include lease debt in the debt, the reason lease commitments are like debt is they're contractual commitments. That's why we treat them as debt. You got to make them in good times, you got to make them in bad times. You know, there are other things like leases that we should probably also be capitalizing. In the case of Netflix, you know what else I should be treating it as debt, right? I mean, you all
Cost of the content.
It's a content commitments. In fact, if you go to the Netflix footnotes, they'll give you lease commitments and content commitments. This is a bigger problem than just leases. Anytime, if I were doing the Yankees, guess what? All those contracts they've signed with overpaid infielders for the next 5, 7, 10 years become debt because I've got to pay them in good times and bad times. So if you have other commitments, just say yes and go to the page and enter the commitments. You need to know what the commitments are for the future. And then I fix one other mistake that I think accountants are making, and it's costing us big time with the kinds of companies that we're dealing with today. Accounting, as we know, it was built for the old-time manufacturing company, which for them CapEx was land building equipment. You're looking at a pharmaceutical firm. Let's say you're valuing Moderna, or you're valuing Apple or Google. You know what their big CapEx is, right? They're not building machinery or equipment or factories. It's R&D. Again, I've never understood why accounting does what it does with R&D. You know what it does with R&D, right? It expenses it. It's some stupid reason. It's uncertain. So if I built a factory in Kazakhstan, would you let me expense it? Borat could come in and burn it down tomorrow. Uncertainty is a very stupid dividing line. R&D is CapEx. There's nothing to debate. So you know what? If you want to do this right, I would suggest entering yes for the R&D, but then you got to fill the worksheet that's included in the valuation spreadsheet. So if you say no to these, you can ignore those worksheets, but if you say yes, you bring them in. I'll tell you what else I'm including in here. If I'm valuing Uber, what's the equivalent of CapEx for a ride-sharing company? What's a mother load of value for Uber? It's got 100 million riders, right? You know what the equivalent of CapEx for these user subscriber-based companies is? It's the customer acquisition cost, the subscription cost. Those should be capitalized. And I'm not trying to help the company out. I'm trying to hold it accountable because I need to know what they're paying for growth before I attach a value to the company. So that's what these R&D and operating lease commitments allow you to do, is clean up for the accounting. Then as for cash and marketable securities, that should be pretty straightforward for most companies. Though there are a few companies that have actually, remember the old days before the tax law changed, companies used to have cash trapped in other locales which they couldn't bring back. Apple alone had like $140 billion because they brought it back, they had to pay the extra tax rate. They were held in these strange investments that were close to riskless, but they called them long-term investments. Don't ask me why. But most of the time, cash and marketable securities is what you see as that line item. If you have cross-holdings and other non-operating assets, you'll often see that in the balance sheet or holdings of other companies, minority holdings. This is your chance to enter in. If you can enter in a fair value for these rather than the book value, even better. You're saying, how much can this be? When you're valuing SoftBank, you know what's going to be in there? 30% of SoftBank's value comes from one holding. It's what they hold in Alibaba. Indirectly, when you value SoftBank, you're also valuing Alibaba. That will go into that cross-holding, the minority holding. They're supposedly marking up to market, and they should be doing it right. Even accountants shouldn't screw this up because you just have to mark to market price. But that's what will go in there. If you've consolidated some holdings, then you're going to see a minority or a non-controlling interest. I need to know what that is, because when you have consolidated financials, you end up valuing 100% of the subsidiary. You own only 60%. I've got to net out the minority interest. So almost every item up till there comes in the balance sheet. Then I ask you for number of shares. 40 years ago, this was a slam dunk, right? You looked up the number of shares. This is a nightmare nowadays. If you don't believe me, estimate how many shares are outstanding in Peloton. You know what adds layers of complexity? You have a share count. You also have restricted stock units that might be counted or might not be counted, vested or non-vested. It's amazing how many dances they do on these RSUs. I'll tell you what I do. I'm not going to watch these kabuki dances about this is share, these are not shares. I'm just going to count all of your RSUs in there, because here's what I believe. People who own big chunks of these RSUs, whether it's vested or not, are going to hang around to get those RSUs. Because if you have $30 million of RSUs in Uber, there's no way you're leaving Uber before you collect the $30 million. You know who's going to leave? The janitor that you gave 2 RSUs to, saying, no, it's $100. I need another job. So that share count is not as simple as it now. I don't count options, and I'll talk about why later. But I count shares outstanding and RSUs, all classes of shares, Class A, Class B, all in that count. Otherwise, you're going to be ending up getting a value per share that doesn't reflect a true value. So if you look at a Facebook or a Google, Class A, Class B, Class C, how many classes does Google have? They figured out new ways to rub shareholders' faces in the dirt, saying, you thought you had no power before? Let me make it even less power. You had 1 vote for every 10 votes. I'll make it 1 in 100, 0 in 100, minus 1 in 100. It's only a matter of time before they come up with minus 100 for every 100 voting rights that they have. But basically count them all, because they're all shares outstanding. And then I ask you for tax rates. The first tax rate is an effective tax rate. Nothing fancy about this. You know how effective tax rates get computed, right? You go to the income statement, you take taxes paid, accrual taxes. It's really not tax. It's accrual taxes divided by accrual taxable income. Now, I don't know how many of you do your own taxes. I do. And that's a reminder. I have to work on my taxes next week. I use TurboTax. When you're done with TurboTax, just to, I think, depress the final, as they depart, say, congratulations, you're done with your taxes. This year, you paid 31.61% of your adjusted gross. They think somehow this is an uplifting message. That's an effective tax rate. Just take your taxes paid divided by adjusted gross income. That's what an effective tax rate is. The average effective tax rate last year across U.S. companies, across tax-paying U.S. companies, was about 18%. Then you're saying, what the heck is a marginal tax rate? That's a tax rate in your last dollar of income. That used to be 40% in the US because you're 35% plus. Now it's closer to 25%. It's 21% federal, state, and local taxes. It's a good thing because it's much closer to the global marginal tax rate. Europe, it's about 25 to 26%. Ireland is the exception. That's good news across the world, because when marginal tax rates diverge across countries, I don't care what countries try to do, guess where income is going to flow? It's one of the first principles of finance is income will always flow to low tax locales. You can do all the dances you want to talk about how terrible companies are, but it is completely predictable. So the marginal tax rate is 25%. Any questions? So none of these numbers required any estimation. This is your safe place, right? Because every number there you can say, hey, the accountant gave me that number. It's not my fault. I'm preparing you for numbers that are your fault. Because until now, even accountants are comfortable doing valuation. Now I want to let go of your accounting self. The accounting self is all about control, being in control of your destiny. Now open up to the possibility that you have to make estimates and you are going to be wrong 100% of the time. So I'm going to build on, incidentally, I looked at this the last year saying, what if I have 10 years of data, 20 years of data? I really don't need 10 or 20 years of data. I can value a company with 1 year of data or even a half a year of data. But if you have history, that's useful, right? As long as you don't become a slave to history. One of my problems when people download a lot of historical data is they think they have facts instead of estimates. You say, why is your margin 18.335? How come you have 3 decimal points on your margin? Say, that's the margin. Say, so average margin over the average margin over the last 10 years is not a fact. It's still an estimate. I'll tell you what I look for when I look at history. I look for patterns. What's happening to margins over time? What's happening to revenue growth over time? What's happening to reinvestment over time? That's why you look at history. And for mature companies, it can be very revealing. There was a time when McDonald's and Coca-Cola were great growth companies. That was way back in time. And if you do a historical perspective on these companies, you'll see the slackening off of growth and the pressure on margins over time. So look at history, but don't become a slave to it. Yesterday, somebody was valuing, I think it was Grab. You know the story of Grab, right? They did a SPAC, went public, collapsed. He came to me after class and he said, I'm valuing the company, but I have a problem. I said, what's your problem? He said, the financials I have started in 2019. I said, okay. So what if I gave you? What if I told you I could get you the financials from 2016 or 2013 through 2018? How is that going to change your valuation? What are you going to learn? I'll tell you what you're going to find. High growth, money losing company. And I could tell you that without looking at the financials. So sometimes people think that history as the answer to questions. Maybe it does for a mature company. For young growth companies, you're going to learn very little by diving and delving into the history. There's a time to let go of historical data. With young companies, that time should come really quickly because there's not much you're going to gain by delving further and computing a dozen other ratios on these numbers. So the case of Tesla, basically, what do I learn by looking at the past? Its revenues are growing massively. But the good news for Tesla is this is a company that has a history of losing money. It started to lose less money, and in fact, you can people, of course, people who hate Tesla will have a reason for that. They're cooking the books. This whole thing is a charade. The whole thing is going to collapse. People who hate Tesla is convinced it's worth zero. It's not. You can't even argue with them. The whole thing is a scam. Elon Musk is a scam artist. The company is worth zero. This is what bias does to your valuation, right? Nothing I say will convince you otherwise. So now let me give you the numbers that really drive my valuation. These sets of numbers are what's going to drive it. But before I come to these numbers, I stop and get perspective. You know what perspective is, right? Because when I ask you, what's your target margin for your company? You say, I don't know. It could be 30, it could be 50. Perspective basically means looking at other companies in the business and asking what kind of margins do they make. You're saying, what if my company is in a new business? There are no new businesses. There are new ways of delivering old businesses. Uber did not invent car service. We used to have car service before 2008. It took the form of cabs. In fact, we used to have cab service before 1900. It took the form of horse carriages. Nothing that we do is ever new. There are new ways of delivering a business. You're saying, what about Facebook? It's an advertising company. You think there was no advertising before Facebook? It's more directed, more focused. They have a different platform that allows them to have a network. So when people say, look, I don't know what the business, there are no companies in this business. I say, look, step back and think about the business. One of the things that I built into the spreadsheet, another ginzu feature, is I built in industry averages for pretty much everything for, I think, 94 different industries, which I compute at the start of every year on my website. So when you pick a company, I ask you to put in a pull down menu, say what kind of company is it. So in some cases it's easy. You're valuing a chemical company, you pull down this chemicals, you click it. I go look up what the margins look like for a typical chemical company in the US, a typical chemical company globally. I'm not saying you should use those margins. I just want you to see that to get a sense of what kind of business is this. Because if the median chemical company makes 11% and you're giving me a 30% margin, I'm going to stop you and say, tell me what's different about the company. What is it doing that other chemical companies don't? So the first thing I'm doing to get perspective is looking at the sector, and it's pretty depressing, right? What's Tesla's sector? It's the automobile business. One of the 10 worst businesses in the world to be in. You can think of the other 9. Airlines, of course, shows up there every year, right? The margins are terrible. The growth is abysmal. I know Tesla is an outlier, but they're going into a business that historically, at least over the last 2 decades, has a low growth and terrible margins. I also wanted to get a sense of what does big in this business mean? What do revenues look like for a big company? Again, you see what this means for perspective. The young company say, I don't know what can revenues become 10 billion, 100 billion, 200 billion. So I looked at the largest automobile companies in the world in November of 2021. The largest automobile company in the world is Toyota with 285 billion. File that away. Today, that is the largest. So Toyota and Volkswagen sell about 10 million cars a year and have revenues of close to 300 billion. Again, I'm getting perspective. When I put my growth rates in for Tesla, I'm going to check to see where will that put me on this list? Because right now, Tesla is right here, 25 billion. I think it's lots of promise, but what will that promise deliver? 100 billion, 150 billion, 200 billion? So this is where I'm going to ask you for your inputs. And as I said, these are the cells that drive your valuation. And I've tried to keep it simple. Tell me your growth rate, tell me your margin, tell me your sales to invested capital. And in fact, I've given you 2 columns for the sales to invested capital for a simple reason. If you have overcapacity, now Tesla just finished its Shanghai plant. When I did the valuation, the plant had it open. You know what that means, right? At least in the near future, their growth can be covered without reinvestment because they already have a plant ready to go. So if you have excess, so this is your way of building a buffer into your system saying, no, I'm not assuming my company has to reinvest because it might have already, if you have an infrastructure company that's already invested, you can afford to set the sales to capital ratio high and it'll become part of your story that for the near term, they can live off past reinvestment. But in the long term, you've got to come up with a number that you can sustain. So basically, for the near term, for every dollar of capital they invest, they get $4 in revenues. In the long term, that number becomes closer to what I think is a steady state. Now, of course, when you look at these numbers, you think, how do you come up with the 35%, the 16%, the 5%? In the case of the Tesla valuation, November 2021, I knew if I let people go in and enter these numbers, they would do some serious damage to themselves. Because if you're an optimist in Tesla, you know what you're going to do? I'm going to make the 35% 70%. I'm going to make 16% into 40%. And guess what? They'll send me an email saying, I found Tesla to be worth $5,000 per share. I'm going to go buy the shares. I will not be responsible for mistakes that come out of my spreadsheet if you have no idea what you're creating. So I actually created an advanced input page where at each stage I gave people perspective. I said, when you pick growth rates, you sometimes have no idea what that is meaning for your company because growth rates are easy to play with, right? 30 to 40. What's the big deal? I'll tell you what the big deal is. If I use a 40% growth rate, the revenues that Tesla will have in 10 years is $500 billion. What were Toyota's revenues last year? The largest automobile company, $285 billion, selling 10 million cars. So if you put in a 40% growth rate, you better have a really good story of how they're going to make 15 million cars, right? And how they're going to end up. Basically, that story is, half, maybe 3/4 of the cars sold globally in 10 years have to be electric cars, and Tesla has to have a dominant market share. Is that possible? Absolutely. But what I'm trying to say is when you play with revenue growth rates, always check the revenues you end up with because that's what's going to keep you from coming up with crazy numbers. I recently got a valuation of Netflix where somebody played with the revenue growth rate, never checked the numbers, and it projected revenues of $600 billion for Netflix in 10 years. I called the guy and said, do you have Netflix? He said, yes. I said, how much do you pay per year for Netflix? He said, about $100 a year. I must have some kind of a discount because I'm paying like $200 a year. So I said, okay, $100 billion a year. You've got 600 billion in revenues. How many subscribers would Netflix need to have? He pulled out his calculator and said, you don't need a damn calculator. 600 billion divided by 100 is 6 billion subscribers. He said, I don't see where this questioning is going. I said, just hang in there. I have a couple of other questions. I said, what's the population of the world? He said, I don't know. I went on Google, about 7.5 billion. So I said, in your story, 6 billion, and this includes kids, right? So basically in a story, 80% of all human beings, including 2-year-olds and 1-year-olds, will have Netflix accounts. Nobody will be allowed to share. They're all paying $100 a year. He said, but I was just using last year's growth rate. I said, what? He said, I took last year's growth rate and put it into the growth rate for the next 10 years. This is the problem when you play with growth rates. Always check revenue numbers, absolute numbers, no matter what growth. We underestimate the power of compounding. Even though we're in finance, we do this all the time. We talk about the power of compounding. Take your company, double the growth rate. You know what it's going to do to your end revenues if you double the growth rate? It's not going to double the end revenues. It's going to make them 10 times larger. So the reason I set this up, I said, I want you to think about what do you think success will look like for Tesla. Will it be BMW-like, Honda-like? With each one, I said, this is the growth rate you should be using. And then I wanted to give people a chance who said, it's not going to be just selling cars, it's going to be selling batteries. I said, okay, come up with a growth rate and come up with revenues. And remember, the company with the largest revenues in the world is Walmart, and Amazon's getting up there. It's about 400, 500 billion. If you're giving me 2 trillion in revenues in 10 years, you're building a company that's not just exceptional, it's beyond one of a kind. It'll be the first of its kind. So essentially keep those dollar numbers to you. Now the margin number, again, I look for perspective. And if I think of Tesla as an automobile company, there's no point even going on. There's no way I'm going to get even close to the value. Because automobile companies have single-digit margins, even the very best of them. The only way you can get a story going for Tesla that has any heft to it is we told a story of Tesla being that the electric car business is different from a traditional car, that it's more electronics. Think of it as more iPhone than car. Right? Basically, that the cost of making it is primarily the battery. And that's been Elon Musk's story, right? That he's going to revolutionize the manufacturing. I am bending over backwards at each stage in the process. I'm listening to your story. And I'm going to reflect that. And I said, look, you can't be just selling software. Incidentally, Tesla does have a software business that it can think of in the long term. Any of you own a Tesla? No. Do you own Samit? Do you own a Tesla? You know that if you have a Tesla and you buy it new, it comes with the software embedded. And without the software, the car becomes almost useless, right? Everything kind of runs on software. There might be a point in time where Tesla can split the car from the software. Can you imagine you buy the Tesla and every 3 years you got to buy an upgrade to the software? Your car just becomes this hunk of steel sitting in your garage. So I'm willing to listen. As I said, I'm in the middle place here. I'm willing to listen to stories that optimists tell me about Tesla. And they said, okay, it can sell software. I said, okay, I'll give you a software margin on a portion of your business. Obviously, you still have to sell the cars. So my margin of 16% splits between the automobile business and the big tech companies. It's a pretty upbeat story, right? For the investment efficiency sales to capital, again, I'll give you what the numbers look like across. So again, the way I look at these numbers, I look at the sector, I look at big companies, small companies, startup companies, the history of the company. But at the end of the process, guess who's responsible for the final input? It's me. We need to take ownership of our inputs. It can't be an analyst estimate. It can't be the management estimate. It's your estimate. You can listen to analysts. You can listen to managers. That's a sales to capital ratio. I'm almost there because when you come to risk and operations, you got the cost of capital. It's not a theoretical construct. It's what investors out there are demanding. Some of you might be familiar with my implied equity risk premiums that I compute at the start of each month. It's a completely agnostic number, right? I don't use any models. I just say, look, here's where the S&P 500 is. Here are the expected cash flows. What's the internal rate of return? There's no model. This is what people can expect to earn given what they're paying. And I said right now, you look at cost of capital, median cost of capital for a global company is about 6.33%. An automobile company has slightly lower cost of capital. A tech company is slightly higher cost of capital. Again, I'm going to split the difference. The story I'm telling for Tesla reflects this combined story of part automobile company. The good thing about being an automobile company is potential revenues are huge. If you're a software company, you're not going to get 500 billion revenues. You know what Microsoft's revenues were last year? Like 150 billion. But the reason it can have such a high value is it gets a 40% margin. Automobile companies get 300 billion revenues, but their margins are 8%. You're saying, I'd love to be an automobile company with Microsoft's margins. And I'd like to make pigs fly. You can't do that, right? You can't take the best of different stories, put them all in the same valuation. I'm getting as close as I can to a melded value. I'm trying to give Tesla the best of both worlds. But I can't go all the way to tech company or all the way to an automobile company. And finally, on options, you got to treat them as options. Sounds like an absurd thing to say. But options are not shares. You can't count them as shares because they might be out of the money, they might be in the money. They're not shares, which means you can't ignore them, which is what some people do. We know how to value options. In fact, accountants have had to do that when they do expensing each year now because we grant options, they've got to be expensed. So if there are options outstanding, I'm going to value the options as options based on the strike price, the remaining life. It's not rocket science. You plug the numbers in. And that is going to allow me to end up with a value that reflects the option overhang. And finally, we get to the bottom of the spreadsheet. I give you rope to hang yourself. What I mean by that is I built the spreadsheet with protective guardrails where you can't get yourself into trouble. By doing what? By setting a growth rate of 6% forever in your company in US dollar terms. That'll blow up your valuation. You know why? Because your company will then become the economy, the global economy, and interplanetary travel. You've essentially created an outlandish creature. So in my spreadsheet, I've built these protections from you hurting yourself. But in the last stage, I say, if you really, really know what you're doing, I'm going to let you change those assumptions. So, for instance, I change your cost of capital for your company over time towards the cost of capital of a mature company. Why? Because if you have a growth company, it becomes a mature company, it's cost of capital. It does it automatically. But if you don't like that, I say, okay, override it. Tell me what the cost of capital will be in year 10. In my base valuation, I assume over time your return on capital moves to your cost of capital because 75% of companies have trouble making their cost of capital. So I'm going to assume the typical company over time, the return on capital will converge on the cost of capital. But maybe you have a special company, a brand name company, a technology company. If that is, you can override that. In my base case valuation, I've assumed no chance of failure. But if you're valuing a young startup or a distressed company or spur bank, I'll let you override that. In my base case valuation, I assume you are bringing no NOLs from the past. Because you're a money-making company. But if you're a money-losing company, I want that. You know why I need that, right? Because I'm going to use that to shelter you from taxes within the valuation. Because that's the benefit of having an NOL, is you save on tax when you first start to make money. And here's the big change I've introduced, especially in the last few years. One of the things that troubles people about today's T-bond rate is it's too low. The older you are, the lower it looks, right? Let's face it, your frame of reference is determined by how old you are. So if I ask you what's a normal risk T-bond rate and you say 6%, you've been around too long because you probably started in the 1980s. If you say it's 4.5%, you probably started in the 90s. If you say it's 4%, you started in 2000. If you say it's 2%, you probably started 3 years ago. Because your frame of reference comes from what, this is why it's absurd. People are, I know what the normal risk-free rate is. My question is, tell me how old you are. And then we can talk. Because normal is defined by your frame of reference. But the reality is there are people who believe rates are going to go up. In fact, I wager if I went around this room, there's this Fed dance that we played, the Fed sets rates and rates are going to go up. I believe the Fed has very little power to really do much with rates other than tweak them at the edges. But if you believe rates will go up, I allow you to change the T-bond rate over time. It doesn't happen right away, but you say, look, you think that a T-bond rate should be more like 3%. I allow you to enter that 3%. And then over time, I adjust your T-bond rate to 3%. So when you first start, leave it at the defaults. And then if you want to tweak it, go ahead and tweak it. When you look at the output, here's what I want you to check. First, check your revenues. With Tesla, what am I giving it as revenues? $428 billion. That's a really big story. I'm making Tesla the largest automobile company in the world. So don't accuse me of being pessimistic here. This is an immensely valuable company. I'm giving it 16% margins, way higher than a typical automobile company, which means in my year 10, it's making $67 billion in operating income. No company in history has been able to sustain those kinds of, I think Apple makes more because its margins are much higher right now, $67 billion. I discount back at a cost of capital, and over time, not much happens to cost of capital because in this case, I left it at 6%. But if I made it 7% over time, you'd see the cost of capital increase in the last 5 years to go from 6 to 7%. What you see as a present value is a present value. So my free cash flow to the firm, basically, I take my revenues, grow it out over time. My margin changes, that gives me my operating income, margin times revenues. The tax rate over time starts at the current effective tax rate, which is 12%, moves towards, you're saying, why does it have to move? Why can't you just leave it at the effective tax rate? Because when you pay an effective tax rate well below the marginal tax rate, it's not because you're in a lower tax bracket, it's because you're deferring taxes. I'm assuming you cannot defer taxes forever. I might be just crazy, but if you believe you can defer taxes forever, there's probably a padded cell in a federal penitentiary waiting for you. Because you really can't put off paying taxes. Tax rates change, you got your after-tax operating income and free cash flows. The final piece of the output, I take that present value and then I bring in the elephant in the room. Which is at the end of year 10, what happens? The company is a mature company, I give it a terminal value, I discount it back. The terminal value is over $1 trillion. That's 10 years from now. By the time I discount it, it's down to $560 billion. You add it to the present value of cash flows. My total value for the firm is $686 billion. 80% of my value comes from the terminal value. But don't listen to those stupid rules. If more than 60% comes from terminal value, there's something wrong with the valuation. No, there's nothing wrong with the valuation because that's how you make money on a stock like Tesla. Is not from the cash flows you collect while you hold the stock, but from the expected price appreciation. That's what the terminal value is holding a mirror up to. Is where does the value for you as an investor come from? There's no chance of failure, but if there was, I'd have adjusted the value down. I subtract debt, I add back cash, I subtract out the value of the options. Pretty substantial, right? Much of that is Elon Musk's options. He's been granted by his board, which is really as close to a rubber stamp board as you can get. These huge option grants. That's a 55, so basically if you look at how much you lose in options, that's 51 billion right there. It's about 9% of the value is gone. Gives me a value for the equity of 642 billion. Divide by the number of shares. Value per share is $571. Let me ask you a question. Is this a pretty upbeat story that I've told about Tesla?
Yes.
Absolutely, right? And the stock was trading at 1200. And every pushback I got from people who thought it was worth 1200 is, what about the fact that it can sell more electric batteries? I said, have you taken a look at what I have as revenues in year 10? You can do automated driving, you can do electric batteries, $400+ billion in revenues. I'm assuming you can sell everything but the kitchen sink with the car. So have you thought about the fact that they can make, that they can sell cars at a premium price? Why do you think I'm giving them 16% margins? You tell me a story and tell me what you're going to change based on your story. I'm willing to listen. But I'm not willing to listen to the crap that comes from somebody like Kathy Woods, who said, I'll tell you a macro story. Electric cars are going to take over the world. What kind of story is that? I am assuming electric cars are going to take over the world. Otherwise, how will Tesla sell $400 billion plus? The problem with macro stories backing micro investments when there's no effort made to go from the macro to the micro is you're going to do exactly. Take a look at ARK, right? What have they bought? You buy on macro stories. You're going to go through that list and say, that makes sense, that makes sense, that makes sense. Then you ask the question, what else am I assuming when I buy those companies? Then you start saying, that doesn't make sense. It's a big market, but there are 18 other players in this market. So essentially, it's taken my story, in fact, built into the spreadsheet. I told it was a ginzu spreadsheet. I've actually created a story page where I've taken your numbers, put them into a nice, neat page, and at the top, I've left blank spaces where you can now go in and fill in the story that backs up each of your numbers. Because I want you to think about, for each input, what's the story that backs this input? My Tesla story is that it's going to be an immensely successful automobile company, that most cars sold are going to be electric cars, that Tesla is going to find a way to change the unit economics in this business to deliver higher margins. And along the way, find side revenues from software, from batteries that supplement its core revenues. It's a big story. Is it plausible? Yes, I think it is. Is it probable? I think I'm stretching the definition of the word probable. But if the stock dropped to 500, I'd be buying. And when I did this, it was 1200. It's now what, 800? I'm closer to a buy than a sell now. Never say never. I've seen too many people say, I'll never buy Tesla. At the right price, I will buy any company. At the wrong price, there is no company you can induce me to buy. I bought Amazon 2 weeks ago. It was when I bought it was $3,000 per share. It dropped to 2,700. But I have faith. Of course, 10-for-1 stock split. Who knows what the effect will be. But Amazon, that's the 5th time in the last 23 years I bought Amazon, which tells you a little bit about the 4 times before I bought it and sold it. I bought it for the first time in 2001 after the dot-com bust. I sold it in 2004. Never say never. At the right price, you can buy any company. Now, of course, one way to think about this is I've told a story. Could my story be wrong? Absolutely. So one of the ways I hate just presenting graphs as a function of revenue growth. I could do that, right? What's the value per share if I change revenue growth, if I change margins? But I'm acting like each input is independent then. So what I do instead when I want to ask what if questions is I try to frame different stories. So last year I valued this company called Zomato, Indian food delivery, online food delivery company, huge IPO in India. And I did a valuation of 41 rupees per share. And then I got a lot of pushback saying, what if this happens? And I said, okay, you know what? I'll tell you different stories for Zomato and tell you what the value per share will be with different stories. Because with each story, I can think through this is what it's going to mean in terms of growth, margins, and reinvestment. This is your value per share. And guess what? The value per share I can get with different stories ranges from 16 to 150. Doesn't mean that anything goes. But it does mean that there are bounds on value, even with these stories. And it does mean that there's room to disagree. I don't own the story for Tesla. I have a story for Tesla. You'll have your own story for Tesla. So if you tell me that Tesla is undervalued, who am I to talk you out of your investment? It's your money. You want to buy Tesla. Why should I talk you out of it? The only person I have to convince is myself. If along the way other people are convinced by it, fine. But don't blame me if things go wrong. This is my story. I will live with the consequence of my story. But it's not my job to make this other people's story. So that's why I designed the spreadsheet the way I do, is I want people to disagree with my story. Don't bitch and moan about my growth rate. Just change the damn growth rate. It's right there in front of you. Don't say I don't like your margin. Put in the margin you want. Make it your story. Make it your value. Make it your decision. And one final thing that I've discovered that helps me a great deal with dealing with uncertainty. Because a company like Tesla, there's an immense amount of things that create uncertainty, including the fact that their CEO is still a little bit of a teenager, right? I've called Tesla my corporate teenager. And my definition of a teenager is you wake up every morning, you look in the mirror and you say, I have lots of potential. What can I do today to screw it all up? And you can see Elon Musk almost doing that on a daily basis, right? You invest in Tesla, you're going to get that as part of the package. Don't complain, it is part of the package. So one thing I've discovered helps me get more comfortable with uncertainty is I use a program called Crystal Ball. It's an Oracle product, which converts any Excel spreadsheet into a Monte Carlo simulation. You know what you do in a Monte Carlo simulation? Instead of giving a single input, you give a distribution. It's not rocket science. You got to remember your statistics and think about the input. But basically, I can take any valuation and take the inputs, put distributions. And what I get then is a distribution of value. In fact, if you look at my valuations for the FANGAM stocks that I did 3 weeks ago, I valued all 6. I value the company, but I also did simulations for all of the 6 companies, which allows me to come up with 10th percentile. So not only can I give you a median value, that one value, but I can also give you the distribution of values. And I find that immensely useful because I put limit buys at the 40th percentile for all. I didn't do it for Netflix. I just don't like Netflix as a company. But for the other 5, I put it at the 40th percentile. And I don't know whether to be happy or sad, but the markets dropped so much. When I did this, only Facebook was significantly undervalued. I bought it then. But since in those 3 weeks, the other three stocks that were overvalued at mildly or a little bit more, all dropped below my limit buy. So I'm now the proud owner of 5 of the six Van Gam stocks because they dropped. Doesn't mean I'm going to guaranteed to make money, but it does mean that no, if I don't make money, I'm going to say, look, I did my homework. This is the best I could do. But that's part of investing. So the spreadsheet is very simple. So what I would suggest you do is as you go along, you might have to adapt the spreadsheet. I'll give you an example. When I did Paytm, Paytm is like PayPal, a company that makes money from payment processing. You know what the revenues for a payment processing company come from? They come from the percentage of each transaction. It's called a take rate that they keep. So what I did was I added a line item for gross merchandise value because I wanted to start with that because I wanted to experiment with different take rate business stories. Because some businesses go for a low take rate and high gross merchandise value. And there are others like American Express that go for a lower take rate but go for a higher percentage value. So it's still part of the business model. So I added a gross merchandise value line item. You might decide to break. I've done one line item for operating expenses. You can break it out into 2 if you feel that for a Peloton, for instance, I broke the revenues down to fitness equipment and subscription. Because in my story, I think this company will increasingly become a subscription-based company. So what I'm saying is nothing in the spreadsheet is protected, right? There are no macros in the spreadsheet that you have to worry about. So once you get comfortable, make it your spreadsheet, play with it and get a sense of these are the things that drive value. But be wary of adding 15 line items for things that will be very specific to a company because you're going to very quickly lose control of your story. I'm going to I know, run way over, so if you have any questions, I'd be glad to answer them. So,
Professor, this was incredible. Can you go back to your summary valuation page? I just want to recap that one. Yes, sir.
Yeah.
For our viewers here. So you've got Tesla generating $420 billion in year 10 of your model. That's
Right.
$135 billion more.
And also, it'll basically mean if you think in terms of number of cars, it'll probably, what's a typical Tesla sell for now? About 50,000. Even if you think it drops to 40,000, it's about 10 million cars. It's actually good to think in terms of number of cars because you have to make the cars. So 10 million cars. Right now, they have capacity, I think, for up to 1 million. Even that's a very optimistic count. So one of the big things that you've got to factor in here is you got to add 9 million cars of additional capacity, right?
So 10 million cars a year, generating $135 billion more in revenue than the largest auto company today.
Yeah.
At a tech margin.
At a margin that no manufacturing company has been able to sustain in the long term. It's a very uncommon story. So I'm actually, I'm taking the Tesla optimist story. You want to be upbeat, you want to be optimistic.
At a 52% incremental return on invested capital and a 6% discount rate.
Absolutely.
And you're coming up with an estimated value per share of $570.
This is why I said, don't tell me macro stories and say that's why I'm buying Tesla, because clearly you haven't done the homework of converting your own macro stories into numbers. Because I've taken your macro story. You can actually say this is Kathy Wood's valuation of Tesla, which then raises the question, why do you have, I think, 10% of ARK is in Tesla? Why would you have 10% of your portfolio invest in a company that even with your big story, you can't justify at the prices it's trading at?
And if you don't mind, just go back one more slide to your output page or to your output page.
Yeah.
Right here. Thank you. I just want to reiterate, you said, keep the valuation model simple. You have 8 lines from revenue growth rate to free cash flow to the firm. That's it. 8 lines.
And my reinvestment includes CapEx, it includes acquisitions. You know why I don't break it out? I don't know what they will have to reinvest in. They don't know what they will have to reinvest in.
But you do know what's required
Exactly.
to drive
What matters to me is I don't care whether you do acquisitions or capex or R&D. You've got to spend money. It's all about cash in and cash out. Why does it matter what name I attach to the cash outflow?
That's the beauty of your model. You use that sales to capital ratio. That drives your reinvestment rate.
Right.
And that reinvestment rate is what is required to drive your revenue growth rate.
Exactly.
And the last thing I'll just point out to our viewers is that you have EBIT times 1 minus T minus reinvestment is free cash flow. That's the same exact formula you gave on slide 8 for free cash flow to the firm, which is revenue times operating margin minus taxes minus reinvestment.
Exactly.
That can be rewritten as NOPAT.
In fact, you could write that equation in 12 different ways. You could write it out the way in most textbooks you'll see is EBIT times 1 minus T minus capex plus depreciation minus change in working capital is free cash flow firm. Same thing.
Yeah.
So basically, in fact, in my class, I do 6. I say, look, it looks like there are 6 equations, but basically it's just algebra. I'm adding them all up, aggregating, stating it as a ratio, stating it as a percent of sales. But ultimately, the question I'm asking is, what do you need to put into this business to get the growth rate you tell me you're going to deliver?
Yeah, it's those 2 middle line items there. EBIT times 1 minus T is your operating income after tax.
Right.
You subtract the investment required to drive the growth, and you get your free cash flow to the firm.
And you also emphasize they're all connected to each other. So if you want me to use a higher growth, I'd say, okay, I'll use a higher growth. But it might mean you have to go out and raise fresh capital. So if you put in constraints on what you're willing to do, like say, look, I don't want to raise capital, I don't want to lose money, then I'm going to say, okay. That'll also mean that you've got to give up. There are no free lunches in this process, right? Because every time you change a number, I come back and ask you, what are the effects of changing that number on these 2 other numbers? Because everything is connected. I hate to use the word holistic because it makes me sound like Deepak Chopra. But valuations are holistic. Everything is connected to everything else. And my problem with a lot of valuations is people take line items and they play with them. That's the right word to use, right? If I let you play with revenue growth and leave everything else fixed, guess what's going to happen? Revenue growth is always going to increase value. Because I'm assuming you can grow at 50% and keep your margins what they are. The problem with a lot of people in valuation is they not only that they never run a business, they never seem to have talked to somebody who's run a business. They say, I'll use 25% growth rate and a 15% growth rate. What does that mean? How do you get a 25% growth rate in the real world in a mature business? Are you taking market share away from somebody out there? Okay, tell me how you're going to do that. Are you going to cut prices? If so, then I'm going to have to cut your margins. Holding people accountable, and that includes managers, investment funds, equity research analysts for the assumptions they're making often means asking questions about, okay, I'm willing to take your core assumption, but tell me what else happens that allows for that core assumption. Yasser, you have a question?
I do have a question. Thanks so much for a very informative talk today. You said earlier on, sort of like a rhetorical question to a lot of growth companies is, tell me what value you add or you will destroy by growth. Now, the question I have is that a lot of the narrative that many high growth tech companies use, for example, is one that's based on it's okay for us to lose money, spend.
Are we talking about growth or are we talking about margins? Let's be specific about the part of the story this is about. Is it about the margin part of the story or the growth part? Because the losing part is about margins.
It's about the margins.
Okay, so it's a margin part of the story. So right now you're money losing and you say you'll make money. I'll then ask them, well, okay, let's assume you get past this early part of your life cycle. You're building up business. Tell me what will make your losses into profits. What has happened? Economies of scale, right? Which means that your costs, so I'm going to look for evidence. As your revenues grow, you can hold these people. They can tell whatever story they want, but the numbers are right there, right? So if you claim as Netflix that as you grow, you're going to create economies of scale, but your content spending grows at the same rate as your revenues, I have a problem with your story because it's not panning out. There's no way you should let Netflix tell that story of, hey, you know what, our cash flows are negative right now, but as we grow, they're going to turn positive, because you've shown no evidence of being able to reduce content spending costs as you grow, because you keep growing in new geographies. You got to make new shows in Spanish, in Hindi, in Portuguese, because Brazil is a big market. One of the things I find useful in thinking about companies is I try to visualize something that captures a company. And for Netflix, what I see is a hamster wheel. The hamster wheel is they created this model where they go to the market and look how many more subscribers we sign. But the way they get the subscribers is by spending huge amounts on new content. A Bridgerton show that they would throw money at, they sign Seinfeld. So they spend money on content, they get new users. The market rewards them with a higher price. They go spend even more on content, get more users. Do you see what the problem is? How do you get off this hamster wheel? You say, just cut content costs. You've trained your subscribers to expect 15 new shows every time you turn on Netflix. I'm disappointed when I turn on Netflix and only 6 new shows. What's wrong with you? Usually I have 20 new shows that I can watch. Most of them are crap, let's face it. Right? They're in languages you don't want to watch. But this is a company that has upended the entertainment business.